If you are comparing Dubai property with the UK or the USA in 2026, there is one number that can quietly change your entire return. Not the headline yield, not the launch discount, the exit tax. And that is exactly why more serious investors are no longer asking only where prices can rise. They're asking where they get to keep more of the gain when they sell. If you want Astra Terra Properties to help you compare tax-efficient Dubai opportunities, shortlist the right communities, and avoid buying the wrong product just because it looks fashionable, message us on WhatsApp early. In this market, the investor who keeps more usually wins more. Welcome to Astra Terra Properties. In this video, I am breaking down why Dubai property capital gains in 2026 look so different versus the UK and the USA, what the official Dubai market numbers still say about demand, and how smart investors should think when net returns matter more than marketing. Let's start with the big point. Dubai is not just a story about appreciation. It is a story about tax efficiency stacked on top of demand. Dubai Land Department reported that Q1 2026 real estate transactions reached $82.52 billion across 60,303 transactions. The same release showed 29,312 new investors, $148.35 billion in foreign investment, and $87.71 billion in luxury real estate investment. Those are serious numbers. They tell us Dubai is still attracting global capital at scale. But for international buyers, the more interesting question is what happens on the way out. In Dubai, individual investors do not pay a standard personal capital gains tax on property sales. That matters more than people think. Yes, you still have acquisition costs, transfer fees, brokerage, and the need to buy the right asset. But when an investor exits with a gain, there is no normal personal capital gains haircut like the one many investors expect in the UK or the US. Now compare that with the UK. Current 2025 to 2026 guidance widely reflects capital gains rates of 18% for basic rate taxpayers and 24% for higher rate taxpayers on many property gains, with a far smaller annual exempt amount than investors used to enjoy. Non-residents disposing of UK properties still face reporting rules and tax complexity. So if your gain looks good on paper, the after-tax number can feel very different. Then look at the United States. Long-term capital gains for 2026 generally sit at 0, 15, or 20% depending on income, but many real estate investors also face extra drag from the 3.8% net investment income tax, possible depreciation recapture, and in many cases state-level taxes on top. That means the headline gain is often not the gain you actually keep. Let's make this practical. Imagine a property investor books the equivalent of a 1 million dirham gain. In Dubai, that investor is mainly thinking about transaction costs and execution quality. In the UK, that same gain may lose a meaningful slice to capital gains tax. In the US, the investor may lose part of the gain to federal tax, possibly the net investment income tax, and maybe state tax too. Same investor mindset. Very different net outcome. That is why Dubai's tax position does not work alone. It works best when combined with healthy market depth. And the depth is real. DLD's Q1 2026 data did not just show transaction value growth. It showed a bigger investor base, rising foreign capital, and continued strength in the luxury segment. That gives international investors confidence that Dubai is not only tax efficient, it is also liquid and globally visible. The mistake some buyers make is assuming zero capital gains tax means every Dubai deal is automatically smart. I do not think that is true at all. Tax efficiency amplifies a good investment. It does not rescue a bad one. If you overpay, buy a weak layout, ignore service charges, or chase a poor tower in an overhyped microlocation, tax savings alone will not protect your return. So, what should serious investors do in 2026? First, compare net outcomes, not gross stories. A lower tax exit plus strong rental demand can outperform a market with similar appreciation but heavier tax leakage. Second, focus on asset quality inside the right districts. In places like Business Bay, downtown Dubai, Dubai Hills Estate, prime marina stock, and selected newer communities with real tenant depth, the tax advantage becomes much more powerful when the product is actually good. Third, think in full cycle terms. Your return is shaped by entry price, holding costs, rental resilience, financing, and exit efficiency. Dubai's appeal is that the exit side can stay cleaner than many Western markets if you buy intelligently. The bottom line is simple. Dubai property capital gains in 2026 are not just about how much the asset can rise. They are about how much of that rise you may actually keep compared with the UK or the USA. And that is exactly why Dubai remains one of the most compelling global property markets for internationally minded investors. If you want Astra Terra Properties to help you compare real Dubai opportunities with smarter net return logic, visit